With the advancement in the technological sector, many fintech companies hold promising futures. Fintech is called financial technology, which is used to describe new tech that aims to improve and automate the delivery of financial services to provide ease for the customers and businesses. In this video, we will talk about the emergence of fintech apps, how they are changing the finance world, and go over fintech companies you should look into. Please don't forget to subscribe and turn on the bell notification before we get started. The traditional financial institutions are basically actors such as private financial companies and governmental financial institutions such as banks that provide financial services. The current financial system we use today consists of some very old and traditional procedures and practices which is time-consuming and not very efficient. As the world is getting faster and faster, people need a financial system that can meet their needs. And the traditional financial system isn't keeping up with the tech. FinTech is a very innovative technology that aims to compete with traditional financial methods in the delivery of financial services. It is an emerging industry that uses technology to improve activities in finance and includes all of the features a traditional bank offers. FinTech services are usually utilized by companies, business owners, and regular people to manage their finances efficiently. Although FinTech is broad, usually any business that uses fintech technology to enhance or automate financial services and processes are considered fintech companies. As an example of a popular fintech app, Robinhood is a free fintech app that allows its users to invest in public companies and exchange traded funds on U.S. stock exchanges without paying commission, foreign exchange fees or account minimums. Over the years, the definition of fintech has evolved. Previously, it was considered a technology employed at the back end of the systems of established financial institutions. Over time, the focus shifted more towards consumer-oriented services. Fintech now includes various sectors and industries such as education, retail banking, fundraising and nonprofit, and investment management. Apart from this, fintech also includes the development of multiple cryptocurrencies such as Bitcoin. The overall fintech industry has approximately a multi-trillion-dollar market capitalization. Now that we know the core of fintech technologies, we will dig deeper into different fintech companies dominating this sector, and how you can invest in these companies for a profitable return. And I have been investing in some of these companies already since early last year. The first company that is taking this industry by storm is Square Inc. Square is an American financial services digital payments company founded in 2009. The company primarily helps small businesses accept credit card payments, track sales and inventory. The company also enables its sellers to start, run and grow their businesses by combining software with hardware to enable sellers to turn mobile devices and computing devices into payments and point-of-sale solutions. Square Cash App has a massive amount of 24 million monthly active users, and they are seeing an exponential growth in their consumer base. In 2016, the stock was selling for $10 per share, and within 5 years, they have seen a tremendous growth of 24 times the price it was selling in 2016. As of today, the stock is trading at around $245 per share. Square Inc. undoubtedly has a great business model which significantly reduces and challenges the credit and debit card fees and overall banking system. Many financial institutions have a keen interest in this company, and some other stakeholders are the Vanguard Group and Morgan Stanley Investment Management, Inc. This investment opportunity can also turn out to be profitable for you, although its valuation has made it far more expensive than other fintech companies such as PayPal or Visa. The purpose of valuation is to track the effectiveness of your strategic decision-making process and provide the ability to track performance in terms of estimated change in value. Market capitalization is the simplest method of business valuation. It is calculated by multiplying the company's share price by its total number of shares outstanding. Nonetheless, Square's stock performed exceptionally well in 2020 with a 189% rise, and Square is still exhibiting massive top-line growth according to the latest financials. However, when you compare the numbers to past performance, the growth isn't as great as it first appears. This is also why past doesn't predict the future. Cathie Wood, the fund manager of ARK Invest, has taken a substantial stake in this company too. Square Inc. takes the second position in Cathie Wood's portfolio with an exposure of 6.36%. ARK Invest owns 6,187,690 shares of Square Inc., and they currently stand at a market valuation of $1.5 billion. The second company that has performed exceptionally well in this industry is PayPal. I believe PayPal doesn't need any introduction since it's well known and is everywhere except in countries where it is prohibited. But here is a brief introduction to the company if you haven't heard of PayPal. PayPal is an American company operating an online payment system in most countries that supports online money transfers and serves as an electronic alternative to traditional paper methods such as checks and money orders. In 2002, PayPal stock grew to 55% on Nasdaq. This growth gave the opportunity to PayPal founders to reshape much of the technology world we know today. In 2015, after eBay purchased PayPal in 2002, eBay spun off PayPal and both companies were divided again. Since then, PayPal stock is up about 56%, and eBay stock is up by 43%. PayPal holds a massive market cap of $297.51 billion, and over the course of 1 year the stock has rallied exceptionally well. The stock was trading at around $140 in May 2020, and as of today, the stock is standing at around a whopping $253 per share. PayPal holds a consistent track record of earnings and sales growth, which is a plus. In the year 2021, the company earned a meager 29 cents per share, and fast forward to 2019, the company earned $2.96 per share. For the year 2020, the firm's earnings grew 31% to $3.88 per share. Many financial experts believe that the company's earnings per share, EPS, could grow at least 18% in 2021 and 26% in 2022. EPS can be useful to determine the profitability and value of the company, but can be an indicator of investors' confidence too. This stock is undoubtedly a great investment opportunity as the evolution of digital payments is impacting the world and is showing exponential growth. The next investment opportunity that we will talk about is Coinbase, which is rather a new one. Coinbase is an American company that operated a cryptocurrency exchange platform. In order to be more cost-effective, the company operates remotely and lacks an official physical headquarters. As we all know, cryptocurrency is slowly taking over the fiat currency, and Coinbase is here to provide a platform to make that happen. Fiat currency is a government-issued currency that is not backed by a commodity such as gold for those that don't know. Coinbase's stock was recently released in the market and closed at a whopping $328 per share in Nasdaq's debut. The shares opened at $381 and reached a high of $429 before dropping back to the closing price. The market cap of Coinbase soared to $85.8 billion. However, the important thing to consider here is that the stock is extremely overvalued as of now. The price-to-earnings ratio of Coinbase is 412.09, which is dramatically higher than the industry average of 20 to 30. As an investor, you must keep this investment on your watch list and observe the developments in the coming months. Coinbase is undoubtedly a good long-term investment opportunity. Still, the timing needs to be perfect while investing in new stock. Another perfect fintech company that must be on your watch list is Morningstar, Inc. It is an American financial services firm that provides an array of investment research and management services. Morningstar's rating systems are based on unbiased independent investment analysis for all levels of fund and stock investors. Their famous star rating uses specific metrics such as creating peer groups and then assigns the stars according to each fund's performance against its peers. Over the course of a year, the company has seen a substantial increase in its stock price. The stock was trading at $140 in May 2020, and by the end of 2020, the stock traded at $230. Morningstar is a must-buy stock in 2021, and the reason behind this is in an overvalued market, Morningstar has a P/E ratio of 44. This reflects that Morningstar can act as a perfect hedge against a possible stock market correction in the future. To conclude everything, it can be said with confidence that fintech companies are here to dominate and challenge the traditional banking and financial institutions. Fintech companies targets consumer needs and want and deploy their services accordingly with frequent updates in their services and applications. Apart from the services they provide, they are dominating the stock market. Fintech stocks are a perfect long-term investment opportunity for investors, and as the world is advancing towards technology, you must have fintech stocks in your investment portfolio. Please like, share, and comment down your thoughts if you want. Thanks for watching and I'll see you in the next video.